Does building a seven-figure investment portfolio feel like an impossible task? Well, it doesn't have to. We're going to hear 5 simple steps that can help you get closer to that goal of a seven-figure portfolio and in less time than you might think. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail 3 straight years and counting. I'm your host, Rob Moise. It's an absolute pleasure to have you joining us on the show here today. We got a brand new studio and we're broadcasting to you live from the Webbrokers Markets and Research page, in addition to our typical YouTube live streams and our broadcast platform powered by On24. We've got a fantastic conversation lined up for you here. We're going to hear about some of those little habits and decisions that can help investors build the portfolio of their dreams. So joining us to discuss this is personal finance keynote speaker Sandy Yong. She's the author of The Money Master, Inside Secrets on How to Make Your Money Grow and Stay Safe. Sandy, thanks for being with us. Great to have you here.
It's such a pleasure to be here in your studio today, Rob.
Yeah, what do you think about the new digs?
It looks incredible.
Yeah, it's awesome. And speaking of awesome, I just want to say, having read your book, I thought it was awesome as well, too, as a primer to get people's personal finance and investing lives in order. What inspired you to write the book?
For me, I have always had a passion for personal finance in my early adulthood years, and I found that it was really difficult, and even people say taboo, to talk about money, whether it was with my peers, my colleagues, friends and family. And so for me, when I had the opportunity to publish my own book, I thought, what better way than to be able to share my experiences and my expertise within this book to help educate millennials and Gen Z.
Yeah, I mean, and these are things that often we don't hear about in our everyday lives, so you almost have to go seek out that knowledge. Sandy, maybe give us a teaser into the future. Is book 2 coming anytime in the future here?
Well, I want to say never, but the first book was quite an undertaking and definitely a big, huge labor of love. And so I'm really proud of it. And maybe in a few years, you never know, maybe I'll be able to accomplish and publish another one. Yeah,
there's a lot of fantastic stuff in book 1, so no pressure to come out with book 2, but yeah, there's a lot of stuff in there. And one of the things I really resonated with was this idea of this millionaire mindset that you talk about in the book. Can you fill us in on that a little bit? What do you mean by that? Yeah,
so I think that when we grow up and as a child, we are absorbing all of these money lessons, whether it's from our parents, through society. And when we become adults, we're now starting our career and earning income. And sometimes we carry with us some myths, misconceptions about money, or even self-limiting beliefs and thoughts. And for a lot of investors, we're in need of trying to retrain our brain and have a positive mindset and to be able to attract wealth and abundance into our lives so that when we are accumulating money, we know how to manage it and to help ensure that it grows.
Mm-hmm. Awesome. And just with International Women's Day on this weekend, I know obviously Gen Z and millennial women is a key demographic that you're trying to reach with this book. Do you have a message for them that you'd want to give to those that are trying to get their financial footing in order? What would you say?
Yes, I do have a couple of key points I want to share with a lot of women for International Women's Day. And I myself have experienced it even in my 20s and my 30s, struggling to navigate my personal finances and learning how to invest on my own as a self-directed investor. And so I believe that women should proactively invest into their RRSP or their TFSAs. And if they are employed, make sure that you're advocating for fair compensation at work and that you're proving to your employer that you are a valuable team member and that you do deserve a raise or a promotion promotion. And a lot of employers do offer a matching program. Say if your company offers some kind of pension or retirement fund or even employee shares or company stocks, look into the fine print and see if your employer can match your contributions as well.
Yeah, it's free money if you can grab it, right? So why not take advantage? Okay, so we're going to get into some of those DIY investing habits that you have that helped you accelerate the growth of your portfolio. And just for our audience here, just so that you know, you can get in on the conversation as well too. So if you're joining us here in our broadcast platform, you can use the question and comments box there, and you can submit your questions, and we'll have a Q&A at the end here for Sandy. If you're joining us on Webroker in our live stream there, you can use the chat box that you can send the questions there as well. And if you're joining us on our YouTube live stream, there's a link in the description that you can follow. That's going to take you into the broadcast platform, and you can submit your questions for us there. So with that said, Sandy, let's get into your 5 habits here. And the first one here is building a detailed financial plan, and you break it down into like short, medium, long-term goals. Why has that been such a game changer for you?
For me, I like to visualize what my future lifestyle will be like, and to be able to categorize that into short-term goals, which are goals that you want to achieve within the next year, midterm goals where you can try to achieve something in the next 3 to 5 years, and then long-term goals could be something 5, 10 years out or even longer. And what I do is that I will figure out what kind of, say, material things that I want, whether it's buying a home or owning a car. Perhaps it's, for some people, they want to start a family one day, or they want to go on an annual vacation, maybe start their children's RESP. These types of goals, when you set a specific date, you'll know how much time you have to achieve it. And then you can work backwards to break it down into more digestible goals, whether they're monthly, weekly, or even daily goals that you can work towards achieving these financial goals.
Yeah, I mean, we often have to juggle like so many different like financial priorities and goals and needs and stuff like that. So, you know, plotting it all out like that in a detailed plan, I can certainly see how that would help. Another one of your habits, move on to your second one here, because this is a really good one. And it's this idea of getting as much money into the investment markets as you can, as early as you can. Why is this so important?
Well, it really all comes down to what Warren Buffett has said before, is that compound interest is the 8th wonder of the world. And for those who are maybe more experienced investors, they can truly see how profound this is. And essentially, for me, I started investing right out of graduating from university, and this was during the Great Recession in 08, 09. And I just made sure that I was regularly, consistently investing in the stock market, no matter if it was going up or down. And by having these habits of contributing to your investment accounts on a regular basis, whether it's your tax-free savings account or your registered retirement savings plan or a bunch of other investment accounts that are available these days, you can gradually build your wealth and work towards whatever your financial goals are.
Yeah, it kind of sounds like the advantage of compound interest is the more time you have to let it work, the more it kind of snowballs into something bigger here. But one of the things that I think a lot of young people might struggle with is, hey, look, I love the idea of investing, but life is expensive out there, right? And it seems like it's only getting costly all the time. What can they do to prioritize investing when they might be getting bombarded with all sorts of other bills and expenses that they need to pay?
I definitely can empathize with the fact that cost of living has increased post-pandemic, and now with this new trade war going on, it can only probably will get more expensive for Canadians. So it definitely is really tough out there for people to make ends meet, who are living paycheck to paycheck and just trying to have a roof over their heads or put food on the table. And so, one of the ways you can do this is to pay yourself first. And simply what this means is that whenever you get a paycheck from your employer, you can set aside a certain portion of this towards your dedicated savings account. And that way it becomes an automated savings habit, and you're still focusing on balancing your needs for today with your wants for tomorrow. And to add to that, budgeting is a really helpful tool to ensure that you are allocating each of your hard-earned dollars towards whether it's your necessities or your wants, and even paying off debt or working towards your investments.
Yeah, I mean, budgeting kind of sounds like a gross word to a lot of people, but it can be really powerful, as can pay yourself first, which is something that I constantly hear from people in the investment industry, DIY investors that have kind of hit their stride. Pay yourself first. You don't even feel the money going out of your checking account and into your investing account, and it can kind of help you build along the way here. Let's get to your third habit here. And this is a really interesting one. It's about building a portfolio out of diversified index funds, which is the approach that you seem to like here, as opposed to trying to pick like individual stocks and stuff like that. And I think the perception that a lot of people would have is that you kind of need to be a stock picker in order to get those like big returns, right? If you take the slow and steady approach with the index funds, like it doesn't add up to as much. What do you think about that idea? Like, why has diversified index fund investing worked so well for you and helped you grow your wealth more quickly?
I've had many conversations with peers who have thought the same way, in that they felt obligated to pick stocks, whether it's because they felt really confident or they're doing their research. But studies showed that active investors who try to handpick stocks tend to underperform the market. And so it really comes down to their investing behavior, right? Because investing, the concept is quite simple, but we're humans, right? And we have emotions. And so with that, sometimes people end up letting their emotions get a hold of them. And just like the markets right now with these tariffs happening, we can see that investors are losing confidence, and some people are panic selling, or sometimes they're holding on for dear life and hoping that they can ride it out in the hopes that this particular stock will rebound. But for me, with index investing or even with exchange traded funds, it's helped me save a lot of time and not stress out about picking the right stock at the right time, just because none of us have a crystal ball with how individual companies will perform in a given year. We don't know which sector or industry, which country will do well, overperform or underperform. And so it's important to kind of tune out the noise, and being able to invest in index funds gives you that diversification and helps to spread out your risk.
Yeah, and actually we have a chart up on screen here, which is really interesting. This always blows my mind. The S&P Global company, they put out these reports called SPIVA, and SPIVA breaks down how did fund managers perform versus just the broader index, whatever it may be, S&P 500, TSX Composite. And over the longer term, we're talking 5, 10 plus years, these active stock pickers, and these are professionals, mind you, they consistently underperform the markets. And it kind of goes to show, hey, if the guys who get paid to do this for a living can't figure it out and don't have a crystal ball, like, does your average person have as much of a hope, right? So I totally hear what you're saying on the passive approach here. Take a little pause in the action here. I have a little trivia question that I want to pose to our audience here when it comes to investment returns and stuff like that. And the question goes like this. What is the average annual total return of the S&P 500 index over the past 150 years? So large sample size here, as of the end of 2024. So we have a few options there on the screen here. We're going to reveal the answer in just a moment here. But Sandy, would you care to venture a guess perhaps?
Sure. So my logical thinking here is that typically when we say stocks or equities will average 6 to 8% in a given year, whereas bonds would give you maybe 2 to 3%, generally speaking. But then I personally own the S&P 500, and I've seen the tremendous growth that it's had over the past several years. So I would say that it's somewhere between answer B and C. But if I had to pick one, I'm going to go with B, just to be on the conservative side.
Okay, well, you know what? You're totally hear your conservatism there. It actually is a little bit better than that, so thankfully. It is actually 9.4%, so it's pretty close to that 10% that you often hear people talk about when it comes to the S&P 500. However, here's the rub. Adjusted for inflation, it's actually 7%, right? And I think people have the temptation to look at the nominal amount and say, well, I'm going to get this kind of return, or this is what the market has returned, but that's not money in your pocket, right? It's the after inflation that really gets in, after tax, frankly, too. So that's kind of how things can be framed in your mind. And I'm just curious, like for you personally, with your investment portfolio, what do you consider to be a good year for you? Like where you're like, I'm happy with how things did. What do you need to see?
I guess double digits, and making sure that it's, I mean, ideally not a loss or, worse than the previous year's performance. But I mean, I don't necessarily nitpick in a certain year just because I am a long-term investor, and I have got several decades ahead of me. And so, yeah, I mean, as long as it's kind of trending upwards over time, then I'm good. And I also keep track of my dividends because I love dividend investing. So.
You are totally an investing nerd, and I mean that in the nicest way possible. I also track all that kind of stuff. Okay, fantastic. Let's get back to our conversation here because you have an interesting fourth habit, and this one I think a lot of people are tempted by, and you say resist the temptation to chase investment trends. This is something that's helped you grow your wealth more quickly. Why can chasing investment trends backfire on an investor?
I mean, let's just look at the past few years, whether it's been meme stocks, cryptocurrency, even going back a little bit further to when cannabis stocks were the thing, and then new and up and coming industry, and we've kind of seen how all those three examples have played out, and even studies show that trendy ETFs, they get a lot of hype leading up to the initial launch. But then when everyone's jumping onto the bandwagon, that's when it's kind of a little bit too late. And when they do eventually launch into the market, the performance is quite tame or lackluster. And so that's why it's important to kind of keep yourself in check. And I totally get it. Social media, there's tons of FOMO going on out there, and I've experienced it myself. But it's just a matter of sticking to your values and understanding what your long-term financial game plan is. And I mean, if you really want to, by all means, you can pick stocks. But what I personally do is I take a very small portion of my entire investment portfolio and I call it my fun money. It's a small amount of money where I don't mind if I lose the entire pot of it overnight because it's just a small portion. But I allow myself to experiment and purchase some fun stocks. And one example is through the Bitcoin ETF that came out a couple of years ago. But I found that it was fluctuating up and down. It was just an emotional roller coaster ride. And from an investing behavior standpoint, it was an interesting lesson for me because even though it made up such a tiny percentage of my portfolio, I was so narrowed in on that performance, whereas all the rest of my portfolio was doing so well.
Yeah, it's interesting you say that because, a few years ago, I spoke with Dan Bortolotti. The Canadian couch potato is his moniker. And I asked him that about, what do you think about, having a little, explore section of your portfolio? Your core might be, index funds or something like that, but you're exploring with little individual stocks. Is that okay? He said, sure, it's okay, but, you're going to fall into the habit that you did where you're paying so much attention to that it can kind of distract from your goals potentially. So something to watch out for, but that makes a lot of sense. Let's get to your fifth investing habit here that helped you accelerate the growth of your investment portfolio. And this was buy the dip. And this is probably something that people have heard over the years here. It's great in concept. Take us through what buy the dip is and how it's helped you out.
Yes, with buying the dip, basically what investors are trying to do is when a stock market or index fund goes down in price, they want to be able to buy more shares at a discounted price or essentially buying it when it's on sale in the hopes that the price will eventually recover and surpass and exceed in value. And I mean, it can work out for some investors, although the timing of it can be quite challenging, just because, again, you never know when you've hit the bottom. And so some people might be buying the dip, but then the stock price can go lower.
Keeps dipping.
Yeah, it keeps dipping. So you have to be prepared for that. But I think this could work well for index funds or exchange traded funds just because you are invested in hundreds, if not thousands, of companies, and so you are spreading out your risk that way. And historically speaking, we've seen that index funds have been able to recuperate and recover from historic losses.
Yeah, actually, we have an interesting chart up right now, and it kind of shows after you see some kind of significant decline in the market, what is the outcome? And a lot of the times you see these big pops that are, in the 10, 20% plus range, at least, based on history, right? We don't know what's going to happen in the future, but it's a pretty compelling case to just stay invested, don't freak out and panic. I'm just curious, what kind of dip in the market gets you excited where you're like, hey, I really want to get back in now?
Just within this past week, with so much economic turmoil, with what's going on, the trade war with the United States, the past several days, we've seen the market going down. And so a lot of people are fearful, which I mean is totally normal. But if you do have the opportunity to invest more money into the stock market while it's down and could be continuing to go down for weeks, if not months, who knows? So much uncertainty out there, but it could be an opportune time to put more money and invest it for the long run.
I think what a lot of people are doing, and particularly during times like right now where there's a lot of uncertainty, is they say, sure, I agree with buy the dip. I want to avoid the dip. All right, I want to sell out of my investments prematurely before that dip happens, and then I'm ready to go with all this cash and I can get a bigger gains, basically. Mm-hmm. What's the problem with that thinking in your view?
Yeah, in theory, it sounds great, but the execution can be quite tough. Again, no one really has a crystal ball to see what the future holds for us. And so whenever you sell your funds or certain equities, and then you're trying to get back in, that amount of time that you're waiting on the sidelines, it's an opportunity cost because one, you could be losing out on dividends, and two, you don't know when the market's going to rally back up. I mean, look at March 2020, 5 years ago, we went into the mid-30s, deficit. But then soon after, if you just held on and stayed cool, the market went back up pretty quickly. But granted, each type of decline will have different variations of time that it will recover. But studies show that for those investors who hang on tight, they don't mess around or tinker with their portfolio too much, and they stay invested in the stock market, they are rewarded over time.
Yeah, and that chart that we just had up on screen is a really great example of that, because if you held on, you would have got, over the last 20 years at least, about a 10%-ish return if you were in the S&P 500 as an example here. But if you missed some of the best days that happened, the best 5, 10, 20 days, individual days in the market, your returns took a big hit over that time. And it's interesting because some of those best days happen after some of the worst days. Mm-hmm. So it kind of shows you can't really pick your timing because you don't have that crystal ball. You have to be right twice. You have to get in and out at the right time, right? So it can be a challenge. In any case, thank you for sharing those 5 habits with us. It's really fantastic stuff here. And just a quick note to our audience here. Are you enjoying the show? Because if you are, make sure you check us out on social media. TD Direct Investing, we're on Facebook, we're on Instagram, we're on YouTube. So check us out there because you can see upcoming sneak peeks at upcoming shows. And you can also see a ton of other educational content that can help you build your investing knowledge and your investing confidence. So yeah, check us out. Anyway, Sandy, we have a fun little segment that I like to call Hot Takes. Okay, and we've heard a lot of interesting ideas in past shows, and I want to bounce some of those ideas off you if you're game to tell us why you agree, disagree, where you kind of fall on the spectrum. How does that sound?
Yeah, sure. Bring it on.
Awesome. Okay. First one here is coming to us from John Needham. He's from TD Asset Management, and he was actually saying that for somebody like an index investor, there can be a risk in holding too many index funds. So let's hear what he had to say.
If you buy an ETF that tracks the S&P 500 or a similar index as an example, you've got 500 stocks. And so, then you go international, you go Canada, you end up with a very diversified portfolio. So if you add too many ETFs, you're likely going to end up in the multiple thousands of holdings. And that's not necessarily bad, but you can dilute your returns and you can actually start to diverge relative to the market if you start to add too many ETFs, which will hold too many underlying holdings.
All right, so Sandy, he was talking about, having a lot of overlap in a portfolio, potentially if you have all these different index funds. How much of a concern would you say that is for you and for people in general?
Yeah, I mean, for myself, I am a fan of asset allocation ETFs, which is essentially one fund that holds a bunch of exchange traded funds. But I totally get what he's saying in the second portion of that video, where if you end up having overlapping sectors or industries, you can be concentrating your risk. And that happened to me personally when I decided to invest in consumer staples. But I also had my S&P 500, which also had a certain percentage exposure to consumer staples. And so when I was kind of assessing these two ETFs, I was like, hey, well, one, why do I have two similar and overlapping exchange traded funds, and why am I paying two types of fees? And so I decided to consolidate that, and then that way spread out my risk.
I think these days, like tech is the sector that people end up being way more exposed to than they might think, because it's like, oh, maybe I hold an S&P 500 fund, and I also hold like a NASDAQ fund, and there's a lot of tech in the S&P 500 and the NASDAQ, right? So I could totally see how that could happen with people. Okay, we have one more clip for you here. This one comes from Jaspreet Singh from Minority Mindset. And he talked about this interesting, let's call it interesting, investing acronym that can help people when they're trying to think about how to take advantage of a market downturn. So let's see what he had to say.
Is you have to understand POOP, P-O-O-P. Now you're gonna say, what the heck is that? P-O-O-P stands for panic leads to overselling, leads to opportunity, leads to profit. That's what you see in every downturn. Things start to go down because the bubble burst. If any bubble bursts, people panic because now they're over levered. They bought things they should have. They're losing money, so people panic, and that leads to then selling, which eventually leads to overselling. If you start to see the overselling, well, now you will see good assets, good investments that are selling for a big discount, which is that opportunity. So panic leads to overselling, leads to opportunity, and that opportunity you can only take advantage of if, number one, you're financially educated, number two, you have money to do that. And then that creates the opportunity for profit if you are patient.
All right, so first off, what do you think about that acronym POOP? First off, before we get into the other question, what do you think about that acronym?
I think it's absolutely hilarious, and he had such a straight face. And because I'm a parent to a young toddler, I've been potty training my son for the past year, and so I much prefer this type of poop compared to the ones I had to deal with at home.
I hear you. I have a 9-month at home, and when he said that to me, I could barely keep a straight face because I was thinking of a very different type of poop when he said that. But in any case, what do you think about that idea that he's floating here? You know, we talked about buy the dip can be powerful, but you know, like you were saying, you invest regularly in the market. So where does this extra money to buy the dip come from in your case? And like, what do you think might be a good rule of thumb for people to follow if they want to take advantage of buy the dip, like with that poop acronym, but you know, they're already investing a lot?
Yeah, it can be challenging, especially in today's economic environment, for people who are already setting aside money into the stock market. I totally get that. And I think one way, given the time of year we're at right now, it's tax season. And so all Canadians should be filing their taxes on time. And we see that a lot of tax filers end up getting a sizable tax refund. I was looking up TurboTax, and they had a study saying that the average tax refund is about $3,644, which is a pretty good chunk of money. And so if you are anticipating this amount in your tax refund, then it may be a good opportunity to potentially buy the dip, right?
Mm-hmm. Yeah, you got this like influx of money coming in, so it's got to go somewhere. Maybe that could be an opportunity. Yeah, that's a really good thought and very timely with tax times. Thanks for that. Okay, we appreciate you playing along with that game there here. And I just want to mention, we were talking about index funds and investing in index funds and passive approach earlier here. And I think what would be really interesting is to show people in our platform, Webroker, how you can actually go about researching some of these funds. So I'm going to throw it over to my colleague, Caitlin Cormier. She's going to show viewers how they can start researching index funds and ETFs in Webroker.
All right, so we are going to use our screener tool to screen for ETFs. I got to this screener page by clicking on Research under Tools and clicking Screeners. And once I'm here, just clicking the ETFs tab. Next, I'm going to click to create a custom screen so I can add my own criteria. Let's start with management expense ratio. Click to add criteria. We're looking for a lower management expense ratio. We're looking for, while I'm here, I'm going to go ahead and deselect mutual funds because we only want to see ETFs in this particular result. Next, let's take a look at maybe some passively managed ETFs. We're wanting maybe that lower cost, so we want to stick with maybe a more passively managed ETF, so something like an index fund. So we'll choose only index funds. Let's talk a little bit about rating. I'm going to click on rating and risk, and one of the things we can see here is the Morningstar rating. So let's go ahead and click to add that criteria and choose 4 and 5-star Morningstar rated funds. So we want to be able to see that information. And finally, let's go with the tracking error. So under performance, we're going to click tracking error. So again, this is going to show us the dispersion of the portfolio's active return versus the benchmark that it's following. And we're going to click to add criteria, and let's get the lowest tracking error. We're looking to really stay close to what the performance of that underlying index is. Once we've selected all that, I'm going to actually choose Canada as well, just to narrow down my results a little bit further, just so I have a few less. So I'm down to 53 results from my original 1400. So I'm going to go ahead and select View Matches. Once I'm here, I can see all of these different funds that meet the criteria that I have input. I can go ahead and rearrange based on whatever's most important to me. So if I'm really looking for something that has a low tracking error, I just simply click on tracking error and it'll rearrange my results based on the lowest tracking error. And again, I can see the Morningstar ratings. I can see they're all index funds and what their management expense ratio is. I can click through to any of these other tabs to see more information about what this portfolio is all about, what its previous performance has been, and those sorts of pieces of information. And finally, if I find a couple funds that I'd like to compare against one another to really get a better kind of look at them one versus the other, I can just go ahead and select up to 5 different funds and choose compare. And then I can really see these funds side by side and compare them and see which one of these might make the most sense for my particular goals or to help me build my portfolio.
All right, thanks for that, Caitlin. Much appreciated. Sandy, we're going to leave the interview portion of our conversation there, but we're not done yet. We got the most fun part of the show, in my opinion, and that's the live viewer Q&A segment. You ready to hear what our folks want to know more about?
Yes, definitely.
All right, let's dive in. So I'm just going to look at my computer here, see what questions we have coming in. We have one here coming in from Stuart, and Stuart wants to know, referring to your LinkedIn page, I know you post on LinkedIn about REITs, but wouldn't someone be better off just buying a REIT ETF? What do you think about that?
Yeah, REIT, I think he read one of my articles I wrote for money.ca. And if you are looking for an easy way to get exposure to, say, Canadian REITs, which are real estate investment trusts, without the hands-on approach of being, say, a landlord or having the need to have high amount of capital, REIT ETFs could be a potentially a good way for you to get exposure into the real estate market, whether it's through residential or commercial, and add that to your investing portfolio. And that way it can be a more hands-off approach.
So, like, what's the benefit then of like choosing one REIT versus like a REIT ETF? Is it again going back to that like diversification aspect and just getting more exposure to everything?
Yeah, I mean, you could pick individual REITs that are out there, but by selecting a REIT ETF, it's already has a diversified holding, so that you don't have to do the hard work of researching all the individual companies.
Mm-hmm. Yeah, the cold comfort for a REIT here, folks, is that yes, you can get your foot in the real estate market here, but you cannot live in a REIT, unfortunately. Cold comfort for people who are dealing with the high property prices here. Let's keep our Q&A moving on here. We have a question here coming in from Scott. Scott wants to know, what percentage of your portfolio is fixed income, and how do you gain exposure to fixed income? What sort of products do you own in that category?
Yeah, I used to have specific bond index funds and bond ETFs, but again, ever since asset allocation ETFs came about several years ago, for me, I have the bond exposure through that. And for those who aren't familiar with asset allocation ETFs or all-in-one ETFs, essentially, what's great about them is that you can pick your ratio of stocks and bonds. So whether the extreme end is 100% equities, and then you've got your 80-20, where it's 80% stocks, 20% bonds, and you've got a 60-40 or 40-60, and so on. And so when you kind of look at your stage in life, right, your financial priorities, where you want to go, to your risk tolerance and your asset allocation, this could be one of the ways that you can be able to align your investor profile with what kind of goals you want to achieve.
Yeah, I mean, asset allocation ETFs, like they definitely make it super, super simple to get really broad exposure. So I totally appreciate why a lot of people like them for that reason. And you mentioned investor survey, investor profile type kind of thing. That's something that you can find on most major financial providers. It's like a short little survey that you can take, and it kind of helps you get a grip of what is your actual risk tolerance and relative to your goals and stuff like that, right?
Exactly, because it's one thing to, I guess what your own individual risk tolerance is, but when you take these really fun questionnaires, it will ask you a broad range of questions and scenario-based questions, and then that way it can objectively evaluate and let you know which kind of range you fall into.
Yeah, I think a lot of folks might like look at the theory behind stuff and say, like, you know, stocks have had the best expected returns, so I'm going to go 100% stocks. But then you're in cold sweats at night because you're freaking out about the market, you know, going crazy and stuff like that. So you might not be as risk tolerant as you initially think. So it is good to take those questionnaires. Let's keep this Q&A train rolling here. We have one coming in from Deborah. Deborah wants to know, what's the difference, you know, between investing in a mutual fund versus an ETF?
Yeah. Okay, so I like to think of them as, even with index funds, so you got index funds, mutual funds, exchange traded funds, and I like to think that they're like cousins, they're very similar, but essentially, well, there's a couple of different factors, but the common thread is that you can buy one type of fund and it will have a whole entire basket of companies or holdings. And this way, it's very easy for investors to just pick one fund rather than trying to buy 500 companies, right? Because that would take forever and it would add up in fees. But the thing is that mutual funds, they do tend to get a bad rep just because they have been quite expensive in terms of the management expense ratio, the MER. And so a lot of DIY investors, if you do your homework, you might be able to find comparable index funds or exchange traded funds. I know my husband and I, we have TD E-Series in our investment portfolio. And so that way we're able to keep our expenses lower compared to mutual funds, and yet still get the same types of returns.
Mm-hmm. Yeah, and the one nice thing about mutual funds that I always found is that you can kind of automate investment right into them, whereas like ETFs, you have to go physically buy the fund, right?
Yes, yeah, that's right. With our TD investing account with index funds, you can automate it, and we don't have to pay a transaction fee when we want to buy more investments on a regular basis. Whereas exchange traded funds, depending on the type of brokerage that you have, there could be some type of like trading fee. So you have to be aware of that.
Yeah, totally. Okay, let's keep it going here. We have another one coming in from Bill. And Bill wants to know, what are the best investments for an FHSA, First Home Savings Account? It's a bit of a tongue twister there, but what do you think about that? Because this is an account where if you're saving for a home, chances are, you know, you're not just taking a super long-term approach, or at least you hope not to be. You're somewhere in that, like, you know, shorter to mid-term range. So what kind of investments do you think would make sense for an account like that?
Yeah, no, that's a really great point. And FHSAs just recently came out into the market not too long ago, and so more financial institutions are offering it. And yeah, it's definitely a great way for people who aspire to be first-time home buyers, especially given that home prices have gone up quite significantly, and a lot of the younger generation feel like home ownership can be out of reach. So it's definitely encouraged to open up an FHSA and see how much time you have to save and invest your money, because for some people, maybe they have a shorter time frame. Maybe they only have 5 years or less. Some people, maybe they have a decade or longer. So I think depending on what your time horizon is, and again, your risk tolerance, you might be able to speak with a financial advisor or professional to help you figure out what kind of investments are suitable. But I guess from a high level perspective, if you do have a shorter time frame, then you might want to go with something safer, even with GICs, which are guaranteed investment certificates, or even bonds. And then that way you do get some return, but without taking on so much risk that you could end up losing your hard-earned money, especially towards a down payment.
Yeah, I mean, you want that money to be there when you go to buy the house, right? I think one thing that people kind of struggle with, though, is seeing how quickly home prices have escalated. You're almost in a situation where you feel like, well, I have to take a lot of risk and hope that my investments pay off so that I even have a hope to keep up with the increasing prices. But you seem to think that it's the traditional sort of asset allocation ideas still hold in terms of your risk, time frame, and stuff like that. Basically, don't try to push the envelope.
Yeah, I definitely would not want to gamble my money away, especially when it comes to home ownership. But you can combine your FHSA with your HBP, the home buyer's plan, through the RRSP. And on top of that, you can add into the mix your TFSA. So even with those 3 types of investment accounts, especially for people who live in metropolitan cities where home prices have skyrocketed, by using a combination of those investment accounts, you can put together a down payment for your house.
Yeah, I think I think I'm correct about this, where initially it was you could only use the FHSA or the home buyer's plan, but they changed those rules and made it so that you can combine all that money together. So that definitely helps with affording the down payment, which can be a pretty hefty sum. We have time for one more question here. This one's coming to us from Amy, and Amy's saying, I'm worried about all the uncertainty with the Trump administration. How are you thinking about your investments in the US and Canada in light of all this that's going on?
It's definitely a very scary time for Canadians, especially because the price of groceries will most likely go up, everyday cost of living. And so even for me, I've taken some time to sit down and reflect on, where am I at in my life and for my family, again, looking at my short-term, medium-term, and long-term goals. Do I need to have some money set aside for the near term, especially when it comes to having an emergency savings fund is more important than ever, especially when companies are forecasting to have more layoffs. And so it's a good time to reflect and assess the portfolio that you have created for yourself. Does it still serve the same purpose, and do you think it's going to withstand what's going to come? And by kind of taking those things into consideration, not that you should tinker around with it too much, but having said that, if you need to make adjustments to safeguard your investments, then this might be a good time to do so.
Right. So it's, we're not deviating from this idea of tuning out the market noise and stuff like that, but we are being reflective over, what our needs are, maybe in the more short term as things get a little crazy potentially, and make sure that our portfolio is still kind of aligned with what we're going to need, right?
Exactly.
Okay. Thank you for playing along with Q&A here. That's all the time we have for that. But just before we go, do you have any final thoughts you want to share with our viewers before we let you go?
I would say that think of investing as a marathon and not as a sprint. And what I mean by that is that you want to be able to build those habits that we've discussed and ensure that you have these building blocks and to take your time, pace yourself. Because you will come through obstacles and financial roadblocks along the way. You will make mistakes. The stock market will correct itself and it will crash, but hopefully, as we've seen in the past, it's recovered time and time again. And so even though there is a lot of daily noise and out there, especially now, just focus on your long-term vision and stick to your financial plan.
Yeah, I think it's really tempting, especially in the age of social media, to always think about like short term, like what's the buzzy thing here, but keeping the big picture in mind can definitely help people. We're investors. It's a long game, as you say.
Exactly.
Awesome. Well, thank you so much for joining us, Sandy. Really appreciate you taking the time. And for those in our audience, thank you too for tuning in as well. We love having you here. Remember that we run this show every Thursday at 2 p.m. Eastern, so you can always tune in here on WebBroker, now in the Markets and Research page, as well as on our YouTube live streams and in our broadcast platform. If we are interested in checking out some other stuff here, we have coming up next week an interesting conversation with Bilal Dalek from BD Investing. He is going to tell us about his ambitious plan to make $1 million portfolio within 10 years. And that's something that many Canadians don't achieve in their entire life. So make sure to tune in for that one. It's going to be a really interesting conversation we're going to have with him. But for now, we're going to have to say goodbye. Thank you so much for tuning in, and we'll see you all next time. Have a good one.
Have more questions? Check out the links to the right and in the description below.